Hey guys, RC Peck here, and I'm going to talk about something that probably sounds incredibly boring, but it impacts your wealth. And that is, I'm going to start with talking about bonds. Specifically, I'm going to talk about German bonds, Japanese bonds, and US bonds, and talk about why, even if you never buy a bond, how it's still going to impact your portfolio. Then I'll do a little tour of what's going on in the market because it is continuing to break out. And it's important to know what's breaking out and what isn't to help you understand what 2021 is going to be like. So let me jump over and do a partial view. And let's start with the 10-year German Treasury yield. So if you look at the screen here, this guy, let me just make sure my mic's okay. Clearly the trend is lower. If you look, you can see there's a horizontal red line. That is the zero rate for German bonds. You can see it touched it a little bit in 2016, but then fully broke through it in 2019, and it's continuing to trend down. The reason this is important is Germany is the engine of Europe. Europe's the largest economic zone on the planet, and they have negative interest rates. And that's going to drive people's behavior. That's going to drive and push how they behave with their saved money. And even if you're not in Europe, it's going to affect you because those Europeans are going to be looking where to put their money throughout the globe. You then look at Japan, and Japan to me is so fascinating. I highlighted the area here. Actually, let me get rid of this thumbnail. It's annoying to see that. So the Japanese 10-year has been right around that 0 point for 1, 2, 3, 4, 5 years. So Japan controls, look, all major countries manage their interest rates. But what's interesting about Japan is they got down to zero first. The country did not just dissolve. It's actually doing well. It's actually breaking out to new 30-year highs and looking to hit and attack that 1989 high. So I think the central banks of the world are looking at what Japan did. Again, they're the third largest economy on the planet and said, okay, developed economy, kept it at 0% interest rate. I think we'll do a lot of what Japan's doing. And here finally their stock market's breaking out to new lifetime highs. I come back to this, and I've come back to this a couple of times because if you listen to any economist or someone who looks more at the economy or economics, they said Japan is a bug looking for a windshield. But here we are decades later. If you've been to Japan, it's one of the richest countries in the world still, and they're breaking out to new 30-year highs. So then lastly, let's just look at the 10-year. So this is the 10-year yield, the U.S. yield, the yield on the U.S. 10-year. Easy to say. And it kind of wants to come back to this 1.4% area. Right now, it's still below 1%. But it wants to see, I'm guessing it wants to see what happens at that 1.4. I think it's going to get denied at it and get pushed back down because the U.S. is seeing what Japan has done and the U.S. sees what Germany is doing. And so it actually doesn't benefit the U.S. to have an interest rate much higher above its competitors. That's going to drive overall psychology. As far as how is the world doing, I think sometimes about what companies would have to be going higher if the world was on the mend. Like what products are people buying? And to me, I think of Deere & Company. They sell products all over the world. They're a global brand. Someone's not spending $100,000 on a tractor or whatever they are selling unless they think, the future looks pretty good. And here you have Deere breaking out to new lifetime highs in July. And when they broke above that, just look at that. They broke above that and they are now up 54%. This is a boring company that sells tractors and agriculture-like equipment, and it's breaking higher. It's also on the larger side. It's $84 billion in size. So this tells us a lot about how the world economy is doing. And there's a lot of healing that is going on. Emerging markets have yet to break out to new lifetime highs. If I just look at emerging markets, I'm going to zoom out here. if I just look at emerging markets, let me just clean this up and zoom out for you guys. So let's go out 12 years. So this is emerging markets. Let me, just because they repriced it, that has nothing to do with how emerging markets is doing. If you look at this, this is emerging markets going back 11 and a half years. It's done nothing. It has scared a lot of people. You've probably heard for years that emerging market is finally going to do well. It hasn't. And so there has been no bull market for that part of the world. That is the majority of where the world lives. And it hasn't done anything for, in this case, 11 and a half years. We could see another decade-long bull market, which has started recently. You could do the same thing and just look at, you could just look at Europe. Same thing. It's strengthening, has not gotten above the trade war high, is doing its best. It's kind of going sideways right now. But again, this is almost 12 years. Let's actually, I want to zoom back. What does 14 years look like? Yeah, again, this is just a repricing. So that actually, it really skews the look of it. So I just want to get rid of that. Let's see if I can squeeze it out by doing that. Yeah, so again, you have Europe, the largest economic bloc on the planet, still having not broken out to new lifetime highs. And the same thing with, emerging markets. So the US has been crushing it, and they continue to crush it. This is a theme I see over and over, that people are taught that the baton has to be handed back. Like, okay, the US has had a good run. Now Europe has to lead. And so far, it's not. So far, emerging markets is not. And the world is on the mend. Maybe not the bottom 90%, which is a super sad story. But when you have stocks like Deere and Company breaking out, and they broke out not just recently, but they broke out in July, and they're up 50, 60%. That's telling you that this is getting stronger and stronger. And it's very likely that things could get explosive in 21 as Europe, as the emerging markets, they break out to new lifetime highs. That's going to bring even more interest in to the markets. And as I started off at the beginning of this conversation, you then have German bonds paying you nothing, Japanese bonds paying you nothing. And by the way, I'm not even adjusting for inflation. They're just not paying. I mean, Germany's giving you negative, Japan's giving you 0, and the US is giving you just below 1%. And everyone has a different inflation rate, but certainly if you live in one of the more expensive counties in the US, your inflation rate is 2, 3, 4, 5%. I know I'm in the Seattle area, and inflation rate is probably 3 or 4%, depending on what you're having to buy. So a sub 1% yield is not, it's still negative. But this is the world we're in. These are the cards that we've been dealt. And the problem is people just get scared over and over with economic data saying it's going to crash. We shouldn't be this way. Cyclically adjusted price to earnings ratio, that's the CAPE number. They're at historic highs. This PE ratio is at historic highs. That PE ratio has had historic highs. This relative to whatever price, and it gets all this like blah 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 blah, and next thing you know, you're in cash for 4 years and the market's up 100%. Like, that's really, really, really painful. And so part of my hope in showing you this is to go, gosh, RC always comes back to price charts. Like, he's showing you Europe right here in a price chart. He showed emerging markets in a price chart. And I'm showing you this kind of at an index. Like, here is China, but this is the tracking symbol FXI. So this is priced in US dollars. And still, it's wanting to break. It's wanting to get to new lifetime highs. It's wanting to move higher. It hasn't yet, but it wants to. And so as you move around the globe looking geographically, you see the world wanting to break out. You could do the same thing. I'll go back to the US here. This is mega cap right here, and I'm super zoomed out. So let me just get back. Here's mega cap. So this is the Dow Jones 30. Now, it's not necessarily has to be the 30 largest, but these are mega cap. It's broken out to new lifetime highs. If you call the S&P large cap, it's broken out to new lifetime highs. If you go mid cap, you now look at mid cap, and finally mid cap broke out to new lifetime highs right there, and they're up 10% above old lifetime highs beginning of the year. And then you have small cap right here, same thing. They broke above their COVID high, but they still didn't get above their 18 high. So they're just now hanging out in new fresh highs. This is brand new to small cap, brand new to mid cap. Europe's about to, I believe, maybe there's a little bit of predicting there, but they want to come online. Emerging markets wants to come online. So we have the sizes, mega, large, mid, and small, coming online, breaking to new lifetime highs. Right? They're joining the party. Finally, they're finally joining the party. Who's not joining the party is the financial sector. Here's the financial sector still struggling below their COVID highs right here at the beginning of 2020. It's still below that, right? You have XLRE, which is the real estate sector, is way below. I mean, its COVID high is back here. You can't even see it, but it's way below its high for the year. And at least right now, looking in a very weak, having a weak stance. Here's energy right here. Again, just looking horrible. So you have these three sectors: real estate, energy, and financials. They're still not back up off the ground. I mean, they're still in pain. I know people are trying to look for turnaround stories, and they're buying these things, and they're really, what they're burning is opportunity cost, right? They could be in things that are already moving higher. I had one more sector I wanted to show you. XLU, just we'll end with XLU. Here's utilities. This is the safety. This is the safe part of the market. This is where people over the age of 50, 60, and 70 have been taught. They've been taught with ideas from the 1970s and the 1980s. Modern portfolio theory came out in the 1950s. Check me on this, but it's certainly a half a century old. People are using old scripts. They're fighting old wars, and it's hurting their portfolio because they've never been taught how to read a price chart. They've never been taught how to be attached and practiced being detached from what they own, but being very attached to how their portfolio grows. So I'll end here with XLU. There are a lot of things breaking out to new lifetime highs. In fact, they broke out, they've consolidated, they're breaking out again, and it's not just in the US. It's all over the globe. It's in different sectors, but it's not in these really weak sectors right now. And the reason I believe this is because, again, the people that are in utilities, we're talking people in their 60s and 70s who have never been taught to read a price chart and go, is what I'm doing actually best for me? Guys, thank you so much for being more. Please hit the like button. It helps YouTube and Google. Love when you hit the like button. So I appreciate that. And I will see you guys on the next video. Until then, thanks so much for being in my world. And again, this is RC Peck. Okay, bye guys. Hey guys, if you liked this video, you're absolutely gonna love our trading service. And if you've tried trading before and it hasn't worked or you've struggled, it's because you're making one of 7 mistakes, I guarantee it. And after the click, I'm gonna show you exactly what those 7 mistakes are. All right, I'll see you there.